사갓 이쇼츠에고시 사갓 사갓 이스타간 쇼츠에고시 나가자.
Hello everyone and welcome to the lecture 8. Today we will talk about managing debt and understanding credit. So first let's look at the importance of managing debt. So debt can be useful but must be managed wisely because your excessive debt can hinder your future financial goals. Understanding how debt works is crucial for long-term financial health, and it's important in this introductory course to understand the basics. So let's take a look now at types of debt. Yes. So and you can use different classifications. So in this case we're talking about secured debt backed by an asset, such as mortgages and auto loans are good examples of secured debt. And then unsecured debt not backed by an asset, and good examples are credit cards and personal loans. Another classification is good debt versus bad debt. So good debt is considered student loans, mortgages, because they lead to asset growth, while your bad debt, such as high interest credit cards, can create financial strain. Yes, and so if you are having a debt, it's better to have a good debt. Now let's look at the example of secured versus unsecured debt. So Janelle has a mortgage, which is a secured debt, and a 10,000 credit card balance, which is unsecured debt. So, and the mortgage builds equity in her home, while the credit card accrues interest without building an asset. So that's why you want to have more of secured debt and less of unsecured debt, or good debt, more and less of bad debt. Now let's continue with interest, which is the cost of borrowing money. So, and there are two types: fixed interest rate, stay the same for the long term, and then variable interest rate that fluctuates with the market. And compound interest, yes, the concept that we've covered before. It increases the total amount owed over time, and that's how it works when you put your money into deposit, for example. Yes. Now let's take a look at the impact of interest. So in our example, Malik borrows 5,000 with an 18% annual interest rate on his credit card. So by making minimum payments, his balance grows as interest compounds, costing him much more in the long run. Yes, so it's better to have money on deposit so that you will accumulate more money due to compound interest, but it works also when you are having a debt. So, and it's a good idea to keep your debt to income ratio low. So, and you can use it to evaluate borrowing risk. So how do you calculate this ratio? You take total monthly debt payments and divide by gross monthly income. Yes, so a DTI ratio below 36% is ideal for most borrowers. So keep it around 36 or lower, so that you are on the safe side of borrowing. And here's an example. So Saule earns 5,000 per month and has 1,500 in monthly debt payments. Yes, so her DTI would be 30%. So we calculated by using this simple formula: 1,500 of debt payments over her monthly income of 5,000, which makes her a good candidate for a new loan. Yes, and usually banks, when they're deciding whether to give credit or not, they're also using this ratio and also looking at credit score. So let's take a look at minimum payments versus full payments. Yeah, so minimum payments, they keep accounts current but increase interest charges, and full payments you will avoid interest and helps reduce debt faster. Yes, so credit cards benefit lenders more when only minimum payments are made. Yes, so and when you are using credit cards for building your credit score, you need to take that into account. So, and here's an example of minimum payments trap. When Talgat owes 2,000 on a credit card with 20% interest, and if he only makes minimum payments of 50 per month, it will take him over 10 years to pay off, with interest costing him an extra 2,200. Yes, so when you're using any financial tool, you need to kind of take into account all financial risks. Now let's take a look at debt repayment strategies. Yes, and I think we've already talked about these strategies in the previous lectures, but it's a good refresher because it's not only what you know, but also how you apply it in real life. Yes, so strategies. First strategy is debt snowball. When you pay off smallest balances first, then roll payments into larger debts. So it's like you're getting quick wins right away. In debt avalanche, you pay off debts with the highest interest rates first. Yeah, so it will take more time when you feel like the positive effect. Both methods can help eliminate debt, but the avalanche method saves more on interest, but it takes more time as well. So, and here is an example of debt snowball versus debt avalanche. So Jana has 3 debts, 500 with 10% interest, 2,000 with 15%, and 5,000 with 20% interest. So using the snowball method, she pays off the 500 first, gaining momentum. And using the avalanche method, she starts with a 5,000 loan to minimize interest costs. Yes, so based on your situation, you should decide which method is better to use. Consolidate and date. So you want to combine multiple debts into one loan with a lower interest rate so that you keep track of your payments. Yes, because it simplifies payments and can reduce total interest. And you should be careful of fees and longer repayment periods that can increase total costs. Yes, so there is no one solution that fits all. Based on your situation, on your needs, you should kind of think about these strategies. So an example of debt consolidation, Murat has 10,000 in credit card debt across 3 cards with interest rates or in the range of 18 to 25%. So he consolidates into a personal loan at 12%, lowering his interest costs and simplifying his payments. So, and if you are struggling with paying your debts, then you can consider filing for bankruptcy, but you need to be aware of the consequences Yes, so bankruptcy is a liquidation of assets to pay off debt, and it stays on your credit report for a certain period of time and severely impacts your credit scores. Yes, so like you need to think twice before filing for bankruptcy, but if you have no other choice, then you should use it. So, bankruptcy decision. Linda has 100,000 in debt and can't make payments. And so she files for bankruptcy, wiping out most of her debt, but losing her car and house in the process. Yes, so she has no debt, but she also lost her assets. Yes, so you need to kind of think about trade-offs that you're going to make and use it as a last resort if there are no other options. So now let's move on to credit scores, because it's an important concept that you need to understand when you're borrowing money. So credit scores measure credit worthiness, and factors influencing credit scores: payment history, yes, if you're paying on time, amounts owed, yes, so if you took a big loan and paid it successfully, then your credit score would be higher. Length of your credit history, yes, so either you have a debt like for 5 years or for 25 years. Then new credit and credit mix, yes, so all these are the factors that will influence your credit score, and you want to have a good credit score that you can borrow more and with less interest. So we have Quad, who has a good credit score due to consistent on-time payments. Yes, so low credit utilization and a mix of credit types: credit cards, mortgage, and student loans. So because of his good credit score, he's approved for a low interest car loan. Yes, so that's why it's better to keep track of your credit scores and try to keep it as high as possible. So a higher credit score can lead to lower interest rates, better loan terms, and more borrowing options, as we talked about previously. And lower scores may result in high interest rates or loan denials. Now let's take a look at the example of credit score and loan approval. So Aysulu applies for a mortgage, and she has a good credit score of 780. And credit scores are in the range between 1 and 1,000 in our country. And she qualifies for a 3% interest rate. And her friend with a score of 620 only qualifies for a 5% rate, which increases her monthly payments by 200. Yes, and as you can see, if you have a good credit score, then you can borrow more and with less interest. So how do you build credit responsibly? Yes, so you use credit cards responsibly by paying off balances in full. Avoid opening too many new credit accounts at once, and maintain a good mix of credit, installment loans, and revolving credit. Yeah, so it's kind of a strategy to build a good credit. And how to build credit from scratch. So Alibek opens a secured credit card, makes small purchases, and pays off the balance each month. And over time, he builds a strong credit history and qualifies for an unsecured card. Yeah, so this is a way to build your credit score from scratch. Now, you should monitor your credit. Yes, regularly check your credit report for errors. Use free credit monitoring services to track changes and correct errors immediately. so that you can prevent any potential damage to your credit score. So, and here's an example how to correct your credit score. Karl Gash finds an error on her credit report showing a delinquent account that she never opened, and she disputes the error with the credit bureau, and it is corrected, raising her credit score by 50 points. Yes, and with more and more development of technologies, it's important to keep track of your credit reports. Yes, because these errors, they will kind of lower your credit score. Okay, so one of the metrics that you can use for managing your debt is credit utilization ratio. Yes, so it is the percentage of available credit you are using. So your ideal ratio should be below 30%, and it is considered as a healthy score. So maxing out credit cards can significantly lower your credit score, so think twice before doing that. And as usual, let's take a look at the example of credit utilization impact. So Dawlet has a credit limit of 10,000 and regularly uses 9,000, 90% utilization. And his credit score drops, and by paying off 7,000, his utilization drops to 20%, improving his score. Now let's take a look at the dangers of payday loans. Yeah, short-term, high-interest loans can trap borrowers in a cycle of debt, and then it is harder to get out of this cycle. Yeah, so you will need to put more effort, find more financial resources, because in this cycle of debt, interest rates can exceed 400%, making it difficult to repay, and only use as a last resort and explore alternatives first before making this decision. Because otherwise you may get into payday loan trap. So Kairat takes out a 500 payday loan with a 400% annual percentage rate, and he can't repay it in time, and the loan rolls over, accumulating 200 in interest after just a few weeks, putting him in deeper debt. And how can you avoid these debt traps? Yes, so build an emergency fund to avoid relying on high interest debt. Live within your means and budget for unexpected expenses. Seek help from credit counsel if you are struggling with your debt. And here is an example of credit utilization impact. So Aygul has 20,000 in credit card debt and struggles to make payments. And she works with a credit counselor to set up a debt management plan, consolidating her debts and reducing her interest rates. And she pays off the debt over 4 years. So this is the end of lecture. Now let's conclude it. So what are the key takeaways? So it's a good idea to understand the types of debt and how interest works. Use debt repayment strategies like snowball or avalanche to eliminate debt or to minimize it. Then monitor your credit score and maintain responsible credit usage, and try to avoid high interest loans and seek help if debt becomes unmanageable. So this is the end of lecture 8. Thank you for your attention, and see you in lecture 9. Так. Сейчас перерыв 5 секунд. Ага.
Как дела?
Что у вас как?